You had the plan. You identified the trend. You marked the level. You told yourself, if price pulls back to the zone, I am entering. Clean structure, defined risk, everything aligned. Then price pulled back, exactly to your zone, exactly where you said you wanted it. And something happened that you did not plan for. The red candles started printing, one after another, price dropping toward your level with force. And instead of feeling ready, you felt afraid. The plan that looked clean on a static chart suddenly felt dangerous on a live one. The zone that looked like opportunity suddenly looked like a falling knife. So you waited, just a little longer, just until it stabilized, just until the red candles stopped and something that felt safer appeared. But safe never came. Price bounced from your exact level. It moved in the direction you predicted. It did everything your analysis said it would. And you were not in it. Because the pullback, the very thing you were waiting for, scared you out of the trade when it actually arrived. This is one of the most painful experiences in trading. Not because you were wrong, because you were completely right and still could not act. Your analysis worked. Your psychology did not. And in this video, we are going to examine exactly why pullbacks trigger panic, even in disciplined traders. What is happening neurologically when red candles activate your threat response? And what the internal shift looks like that allows professionals to enter precisely where most traders freeze. Let's go deep. Part 1. The psychological paradox. Most traders understand the basic mechanics of price movement. Trends do not move in straight lines. They advance, they retrace, they advance again. This is not a theory. It is the observable structure of every trending market across every time frame. Pullbacks are not anomalies. They are the mechanism through which trends develop. They shake out weak hands. They reset momentum. They create the lower risk entry points that allow new participants to join the trend at better positioning than those who entered at the breakout. Every experienced trader knows this intellectually. They have read it, they have studied it, they have identified it on historical charts countless times. But when a pullback occurs in real time, when the red candles are printing live on a position they are considering, that intellectual knowledge disappears, replaced by something older, something faster, something that does not consult the analysis before responding. Panic. Not dramatic panic, not screaming and keyboard slamming panic, quiet panic, the kind that looks like hesitation, the kind that feels like caution, the kind that says, let me just wait a little longer. And that quiet panic, disguised as prudence, is responsible for some of the most consistently missed opportunities in trading. Because pullbacks feel dangerous precisely when they are most valuable. And the discomfort of that moment, the discomfort that makes every rational trader hesitate, is not a signal to wait. It is the entry fee for early positioning. Part 2. The neuroscience. Why red candles trigger threat response. Let's go inside the brain. Because the panic that occurs during pullbacks is not a failure of analysis. It is a neurological response to a specific visual stimulus. And understanding it at that level removes the self-judgment and replaces it with something more useful, a plan. The brain processes visual information faster than conscious thought. Before you have read the candle, before you have assessed the structure, before your prefrontal cortex has had the opportunity to apply your trading criteria, your visual system has already categorized what it sees: red candles moving downward. And the brain has an ancient, deeply wired association with things that move toward you rapidly in a downward direction: danger. This is not metaphorical. Research in visual neuroscience shows that the brain's threat detection system, centered in the amygdala, responds to visual stimuli associated with negative outcomes before conscious awareness registers them. By the time you are consciously deciding whether to enter the pullback, your amygdala has already been active for several hundred milliseconds, already flooding the system with cortisol, already narrowing your perception, already generating the feeling that this situation is more dangerous than it was a moment ago. The red candles are not telling you the trade is invalidated. Your amygdala is telling you the red candles feel like threat. And in the absence of a clear internal structure for distinguishing between genuine threat and temporary discomfort, the feeling wins. The entry is missed. There is also a second neurological layer specific to pullback psychology: anticipatory loss aversion. We know from behavioral research that the brain weights potential losses approximately twice as heavily as equivalent potential gains. But anticipatory loss aversion goes one step further. It activates loss-related neural circuits not when a loss occurs, but when a loss seems possible. During a pullback, price is moving against the anticipated direction. Even if the position has not been entered yet, the brain begins simulating the potential drawdown. It runs a preview of what it would feel like to enter here and watch price continue falling. That simulation activates the same neural circuits as an actual loss, which means the discomfort experienced during a pullback, before entry while the trade is still theoretical, is neurologically similar to the discomfort of being in a losing trade. The brain is experiencing a loss that has not happened, and it is making decisions based on that imagined experience. Decisions that consistently push entry timing later, into the recovery, where risk is higher and reward is lower. Charts communicate emotion visually. This is not an accident. The color coding of candlestick charts, green for upward movement, red for downward movement, was designed for rapid visual interpretation. And it works. Too well. Green candles create a feeling of progress, of alignment, of the market moving in the right direction. Red candles create a feeling of danger, of incorrectness, of the market moving against you. This visual bias operates independently of context. It does not matter that the red candles are part of a healthy pullback within a strong uptrend. It does not matter that the red candles are approaching a key support level where buyers historically appear. It does not matter that the trading plan specifically identified this zone as the entry point. The red candles look dangerous, and looking dangerous triggers the threat response. Professional traders are not immune to this visual bias. They experience it too. But they have developed a specific cognitive skill that most retail traders have not: the ability to override the emotional response to visual color with structural analysis. To look at red candles and ask not, "Is this dangerous?" but, "Is this expected?" Expected within the context of the trend, expected within the context of the setup, expected as part of the normal mechanics of price discovery. When red candles are expected, when they are simply the pullback phase of a structure that was identified in advance, the visual threat response loses much of its power. Because the brain's threat detection system is most powerful in response to the unexpected. And a pullback to a predefined level, in a trend that was analyzed before the session began, is not unexpected. It is the plan arriving. Part 4. The drawdown problem. Here is something rarely discussed honestly in trading education. Even good trades feel bad in the beginning. When you enter a pullback correctly, at the right level, with defined risk, in the direction of the trend, price does not immediately reverse and move in your direction. It continues the pullback briefly, sometimes for several more candles, sometimes for several more minutes, before the buyers absorb the selling and price begins to recover. During that initial period of continued drawdown, even in a perfectly valid trade, the brain is under significant psychological stress. The position is open. The capital is at risk. Price is moving further against the entry, and the mind begins generating questions. What if this is not a pullback? What if this is the beginning of a reversal? What if I entered too early? These questions are not analytical. They are emotional responses to the discomfort of being in a trade that is temporarily losing. And they are most intense precisely in the trades that have the best structural positioning. Because correctly positioned trades, entries taking during the pullback rather than the recovery, experience the most initial drawdown before moving in the anticipated direction. This creates a deeply counterintuitive dynamic. The trades with the best risk to reward feel the worst immediately after entry. The trades with the worst risk to reward, the late entries taken after the recovery, when the move feels safe, feel the best immediately after entry, because they show profit quickly, because price continues briefly in the direction of momentum, before eventually reversing as the move exhausts. The brain, seeking comfort over correctness, consistently gravitates toward the entries that feel good, which are precisely the entries that have the worst structural positioning. Understanding this dynamic intellectually does not eliminate it, but it creates the awareness necessary to interrupt it, to recognize that the discomfort of initial drawdown in a pullback trade is not a signal to exit. It is the cost of early positioning, and early positioning is where the edge lives. Part 5. Emotional timing versus market timing. This creates a pattern that repeats in the trading sessions of almost every retail trader who has not yet addressed the psychology of pullbacks. It goes like this. Price is in an uptrend. It begins to pull back. The trader identifies the level. The trader plans the entry. Price drops toward the level. Red candles print. The trader hesitates. Price reaches the level exactly. The trader is still hesitating. Price bounces from the level. 1 green candle, then 2. The trader begins to feel more confident. Price recovers 50% of the pullback. The trader enters. Relief, validation. The trade is immediately in profit for approximately 3 to 5 candles. Then price stalls. The recovery exhausts. A short-term reversal begins. The trader, entered at the midpoint of the recovery rather than at the pullback low, is now at break-even or slightly in loss. The stop, placed below the level they were watching, is now uncomfortably far away, because the entry was not at the level. It was 50% above it. Price pulls back again. The trader, frustrated, exits and watches price bounce from the original level and move to the full target. This sequence, hesitate during pullback, enter during recovery, exit during secondary pullback, is the most common manifestation of pullback psychology in retail trading. It produces the worst possible combination of outcomes: late entry, poor positioning, excessive risk relative to reward, emotional exit before the thesis plays out, all because the emotional timing of entry was driven by comfort rather than structure. Part 6. Lessons from professional traders. Some of the clearest insights about pullback trading come from professionals who have developed the ability to act precisely at the point of maximum discomfort. One principle shared consistently among experienced traders is this: discomfort during a pullback is confirmation, not warning. When a professional feels the discomfort of watching price drop toward their entry level, when the red candles are printing and the threat response is active, they have learned to interpret that discomfort as structural confirmation. It means the pullback is real. It means weak hands are being shaken out. It means the level is being tested in a way that will establish genuine support if the trend is intact. The discomfort is not a reason to wait. It is evidence that the entry point has arrived. Another principle observed among professionals who have traded pullback strategies across multiple market environments: the question is never whether price will continue falling. The question is whether the trend is intact and the risk is defined. Professional traders do not try to identify the exact bottom of a pullback. That is prediction, and prediction in markets has no edge. Instead, they ask three questions. Is the trend intact? Is the pullback controlled, meaning orderly, not impulsive or structural? Is the risk defined, meaning the stop level is clear and the loss is acceptable if the trade fails? If the answer to all three is yes, they enter, not because they know price will not continue falling, but because they know the risk is defined and the probability favors continuation of the trend. That is not certainty. It is structured uncertainty. And structured uncertainty, with defined risk and a genuine edge, is all the trading ever offers. The professional is comfortable with that. The retail trader is still waiting for more. Part 7. Accepting temporary discomfort. Let's confront the central psychological challenge of pullback trading directly. It requires accepting temporary discomfort, not eliminating it, not waiting until it passes, accepting it as a necessary component of early positioning. This acceptance is not passive, it is active and deliberate. It is the decision, made consciously in advance before the market is open, that the discomfort of entering during a pullback is the price of better positioning. And better positioning means better risk to reward. Better risk to reward means the system performs better over time, which means the temporary discomfort is not just acceptable, it is the mechanism through which edge is created. Traders who consistently avoid discomfort by waiting for recovery entries are not managing risk better. They are paying a premium for comfort. That premium is paid in reduced reward potential, in worse positioning, in higher likelihood of being stopped out on secondary pullbacks, in missed opportunities on every trade where the full move develops from the pullback level without a meaningful recovery. The discomfort of a pullback entry is real. The cost of avoiding it is higher. Part 8. Practical tools for trading pullbacks with confidence. Let's get concrete. The first tool is the pre-market level identification. Before the session opens, identify your key pullback levels in a calm state, before price is moving, before red candles are printing, before the threat response can activate. Write them down with specificity. If price pulls back to this zone, I will enter with a stop below this level, targeting this level. That pre-commitment, made in a calm state before the emotional environment of a live market, becomes your anchor when the pullback arrives and the discomfort begins. You are not making a decision in the heat of the moment. You are executing a decision made in advance. The second tool is the expected discomfort statement, written at the top of your trading plan for any session where a pullback entry is anticipated. When price pulls back to my level, it will feel dangerous. Red candles will print. I will feel the urge to wait. This feeling is expected. It is the pullback arriving. My job is to execute the plan. Reading this statement before the session primes the brain. It removes surprise from the discomfort. And as we explored in the neuroscience section, the threat response is most powerful in response to the unexpected. When discomfort is expected, its power is significantly reduced. The third tool is the structural checklist. When price reaches your pullback zone and the discomfort is active, run 3 questions in sequence before making any decision. Is the trend intact? Is the pullback controlled? Is the risk defined? If yes to all 3, execute. Not because the questions eliminate uncertainty, because they replace emotional assessment with structural assessment. They engage the prefrontal cortex at precisely the moment the amygdala is trying to dominate. And the prefrontal cortex, given a specific task and specific criteria, can override the emotional response, but only if the task and criteria are defined clearly enough. 3 questions, 3 answers, 1 decision. The 4th tool is the initial drawdown acceptance protocol. Before entry, define exactly how much initial adverse movement you are willing to accept before the trade needs to demonstrate progress. Not the stop, the initial drawdown allowance, the amount of continued pullback after entry that is normal and expected before the bounce begins. Writing this number down before entry removes the shock of initial drawdown, because initial drawdown in a correctly positioned pullback trade is expected, and expected events, as we know, are far less psychologically destabilizing than unexpected ones. The pullback you hesitated on was not a warning. It was an invitation to position early, to enter where structure supported the trade, to accept the temporary discomfort of initial drawdown in exchange for better risk to reward. But the red candles arrived, and the brain did what it was built to do. It protected you from perceived danger, even when the danger was not real, even when the red candles were exactly what the plan described, even when the discomfort was the entry fee, not the exit signal. This is not a failure of discipline. It is the predictable result of a nervous system that evolved for survival operating inside a probability-based environment. The solution is not to feel less, it is to prepare more, to identify the levels before the session, to write the expected discomfort into the plan, to run the structural checklists when the amygdala is loud, to define the initial drawdown allowance before entry, to replace the emotional question, is this dangerous, with the structural question, is this expected? Because pullbacks will always feel dangerous. That feeling will never fully disappear. But with the right preparation, the feeling becomes information rather than instruction, a signal that the entry point has arrived, not a reason to wait. The traders who consistently enter pullbacks correctly are not braver than you. They are more prepared. Prepare better. Execute more. Your growth as a trader begins with self-awareness. The rest follows. I'll see you in the next video. Until then, control your mind.